One of the most respected life science REITs in America just slashed its dividend by 45%. Overnight, no warning. And the investors who held it watched their income get cut nearly in half while the stock cratered. That's not some tiny company nobody's heard of. That's Alexandria Real Estate Equities, an S&P 500 company worth billions. And here's what should worry you. It might not be the last. If you're holding REIT ETFs like VNQ or SCHH right now for the income, there are cracks forming underneath that 3 to 4% yield that most people aren't paying attention to. And when those cracks widen, and they could, the dividend income you're counting on for retirement planning might look very different 6 months from now. Quick disclaimer. I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. So let's talk about what's actually happening in the REIT space right now, because the warning signs are everywhere if you know where to look. And by the end of this, you'll have a framework for figuring out which holdings inside your REIT ETF could be the next to cut, before it shows up in your brokerage account as a smaller deposit. Here's the thing most people get wrong about REIT dividends. They see that 3, 4, even 5% yield, and they think safe, reliable, almost like a bond. But REITs are not bonds. They're real estate companies that are legally required to distribute at least 90% of their taxable income to shareholders. That sounds great on paper, but think about what that actually means. When income drops, the dividend has to drop. There's no giant cash pile sitting there to cushion the blow. And right now, income is dropping for a lot of these companies. Office vacancies in many major US markets are sitting near record highs. Interest rates, even after the Fed's cuts in 2025, are still significantly higher than what many of these REITs locked in their debt at years ago. So as old loans mature and get refinanced at higher rates, that's money coming straight out of the income they can distribute to you. Let me show you what this looks like in practice. Alexandria Real Estate Equities, ticker ARE, had been paying $1.32 per share every single quarter. Consistent, reliable, the kind of thing income investors love. Then in December of 2025, boom, they announced the quarterly dividend would drop to 72 cents. That's a 45% cut. The company reported a net loss of $8.44 per share for the full year of 2025. Their occupancy fell to about 91%. And they had to sell off nearly $2 billion worth of properties just to keep the balance sheet from getting worse. Now here's where this connects directly to your portfolio. If you own VNQ, the Vanguard Real Estate ETF, you own Alexandria. It's one of the roughly 165 holdings inside that fund. VNQ is the biggest REIT ETF in the world. About $36 billion in assets, expense ratio of 0.13%, and a current yield of around 3.8%. On the surface, it looks rock solid, but here's what most investors don't realize. VNQ's total return in 2025 was only about 3.25%. The year before that, around 4.8%. Compare that to the S&P 500, which crushed it both years. And that's the total return, price movement plus dividends combined. The income alone isn't saving you here. And it's not just Alexandria. Analysts have flagged several other REITs inside VNQ as being at elevated risk of cutting their dividends heading into 2026. Names in the office space, names in the medical office sector. Even some net lease REITs that people typically consider among the safest. The common thread? High payout ratios, declining occupancy, and debt that needs refinancing at rates that could squeeze cash flow hard. Now, let's talk about SCHH, the Schwab US REIT ETF. This is another popular one, about $8 billion in assets, expense ratio of just 0.07%, and a yield of roughly 3%. SCHH returned only about 2.2% for all of 2025, even worse than VNQ. And its one-year total return is sitting around 4% as of early 2026. SCHH tracks the Dow Jones US Select REIT Index, which excludes mortgage REITs, so you'd think it would be cleaner. But it still holds many of the same underlying names. Welltower, Prologis, American Tower, Simon Property Group. These top holdings overlap significantly between VNQ and SCHH. So if you own both thinking you're diversified, you might not be as spread out as you think. Here's where Harry comes in. Let's say Harry put $50,000 into VNQ 2 years ago, drawn in by that roughly 4% yield. He expected to collect about $2,000 a year in passive income. Sounds reasonable, right? But over those 2 years, his total return has been underwhelming. The fund's 3-year annualized return is hovering around 6.5%. Not terrible. But factor in that his purchasing power has been eroded by inflation, and the real return shrinks considerably. And now, as individual REITs inside the fund start cutting their payouts, that $2,000 in annual income Harry was counting on could start drifting lower without him even changing a thing. That's the hidden risk. When a REIT inside your ETF cuts its dividend, the fund's overall payout adjusts downward. You don't get a notification, you don't get a warning email, you just get a smaller deposit next quarter and wonder what happened. So, what should you actually be watching for? Here's a simple framework. There are 3 red flags that tend to show up before a REIT cuts its dividend. First, the payout ratio. If a REIT is paying out more than 90% of its adjusted funds from operations as dividends, that's a company running on fumes. There's no margin for error. One bad quarter of leasing and the math just doesn't work anymore. Alexandria's payout ratio was sitting at 57% earlier in 2025, which seemed safe. But then the losses accelerated and the cut came anyway. So even what looks manageable on paper can deteriorate fast. Second, watch the debt maturity schedule. REITs that have large chunks of debt coming due in 2026 and 2027 could face a brutal refinancing environment. If they locked in rates at 2 or 3% and now have to refinance at 5 or 6, that's potentially hundreds of millions in additional interest expense. Regional REIT in the UK, ticker RGL, just announced they're cutting their 2026 dividend target by 20%, from 10 pence to 8 pence per share, specifically because of rising debt costs and the need to retain cash for property upgrades. Their portfolio dropped 5% in value over 2025 alone. Third, and this might be the most important one, watch occupancy trends. Not just the current number, but the direction. A REIT with 95% occupancy that's been declining for 3 straight quarters is potentially more dangerous than one sitting at 88% that's been climbing. The trend tells you where the income is heading, and where the income heads. The dividend follows. Now, does this mean you should panic? Sell your REIT ETFs? No, absolutely not. Real estate has historically been an important part of a diversified long-term investing strategy. And the REIT sector as a whole is not in crisis. The National Association of REITs noted that most companies maintained solid balance sheets through 2025. There are pockets of real strength. Data center REITs, like Equinix and Digital Realty, both top 10 holdings in VNQ, are seeing massive demand from AI infrastructure build-out. Healthcare REITs like Welltower are benefiting from aging demographics. Industrial REITs like Prologis still have strong fundamentals even if growth has moderated. The key is knowing what you own, not just the ETF ticker, but what's inside it, and whether the income those underlying companies generate could realistically come under pressure. Here's what Harry decided to do. He didn't sell everything. Instead, he spent an afternoon actually looking through VNQ's top holdings and identifying which ones had high payout ratios, declining occupancy, or upcoming debt maturities in a rising rate environment. He found maybe 10 to 15% of the fund was concentrated in names that concerned him. That didn't make him sell VNQ entirely, but it did make him think twice about over-concentrating his retirement savings in a single REIT ETF without understanding the exposure underneath. And that's really what this comes down to. The yield on these funds looks attractive, 3 to 4% in an environment where savings accounts are starting to drift lower. That's appealing, but yield without understanding the risk behind it is how people get blindsided by cuts like Alexandria's 45% slash. So if you're holding VNQ, SCHH, or any REIT ETF right now, take 30 minutes this week, look at the top 20 holdings, check their payout ratios, look at their occupancy trends, and pay attention to those debt maturity schedules. because the next dividend cut probably won't come with a warning either. The REITs that survive and thrive through periods like this tend to share a few things in common. Low leverage, high-quality properties in markets with strong demand drivers, and management teams that prioritize balance sheet strength over chasing yield. Those are the kinds of names that could actually raise their dividends while the weaker players are cutting theirs. And that divergence, that's where the real opportunity sits for patient investors. If you want to see which dividend ETFs have been quietly outperforming the REIT space without those same risks, that video